Welcome to Tech Talk Tuesday. I'm your host, Karla, and with me is my fellow co-host and CMT, David Blake. It's Tuesday, April 16th, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out going forward. We do it mostly from a technical perspective. David, I hope that you had a great weekend. How are you doing today?
I'm doing well, Karla. Thank you.
Great. Well, let's get started by taking a look at last week's market activity before we go into what's ahead.
Okay, well, last week was another volatile week for the market. It ended lower. We ended up kind of a slow start to the week. Basically, investors were kind of waiting around for two things. Number one was the some inflation reports with the consumer price index, the CPI, and the producer price index, the PPI, on Thursday. And on Friday, we were getting the kind of the kickoff the earnings season from the money center banks. And there wasn't much to do on Monday and Tuesday, so we kind of traded sideways. But Wednesday came out for the third month in a row. The CPI was a little bit hotter than was expected. Of course, yields moved higher on that, and then, of course, stocks went lower. The Dow actually plunged 422 points on that. We had the 10-year Treasury jumped its highest level since November. I think we ended the week at 453 on the 10-year, and we're, of course, higher than that again today. But EPI came out. It was pretty much in line on Thursday. That was coupled with a strong jobs report. And we had a couple of Fed officials came out kind of calming the market a little bit, saying that despite, another CPI report above expectations, they still expected to see rate cuts happening later on the year. So they were still on the table. We've had they've kind of been all over the place. When the year started, some of these crazies were looking for, 5, 6, 7 rate cuts, which was way out of bounds. But it helped trigger, the markets rally. And then here in the last week or so, we're getting some analysts saying that we're not going to get any rate cuts. And I think that's wrong also. I think we're probably due more for probably maybe 2. We'll have to check on that. But with the hotter than expected CPI, it kind of took the odds of a June rate cut off the table.
Is there anything that could change that?
Now, what could change that? It would be maybe if we start to see earnings come in a little bit soft, which so far isn't happening too much. And the other thing would be if we start to see jobs data start to really weaken, then the Fed might start to reconsider June rate cut. However, at this stage, we've gone from about a 65, 68% probability of the Fed cutting rates in June down to about, 15, 20% tops. They still are kind of a coin toss for July. We'll have to see about that. I'll talk about what my thoughts are on that in just a little bit. But anyway, on Thursday, after Wednesday's sell-off, we got a big bounce on Thursday. A lot of that was from basically on the mega caps, that Magnificent Seven thing. We had big moves in the semiconductors, and also Apple, Amazon, Alphabet, Microsoft. They all surged on that Thursday. We had the Philadelphia Semiconductor Index surge to almost 2.5% on the day. But the thing about it was, and we talked about this in the daily comments, if you don't read those, you should probably get start getting the habit of reading those. We'll tell you what's going on that day, what happened. But you had a very narrow rally. In fact, it was on, I think the AD lines, the advanced decline lines were about flat. The Dow Jones actually finished flat. The NASDAQ was up. It was up almost 2%. But again, it was a very narrow group of stocks. These overweighted mega caps really moved the NASDAQ. And of course, they did it. You had more new lows and new highs on that day. And volume was below average too. So that's what we the NASDAQ made a new high that day on Thursday, which is hard to believe, talking about these big sell-offs we've been having lately. But then again, it just shows you how the force behind these overweighted big mega cap stocks in the NASDAQ. So once that was gone, we came back in on Friday. The money center banks, reported they were kind of mixed. The big problems was that interest income is going to be below estimates, and that kind of kicked another sell-off on the whole market. financial sector ETF, which is XLE. It dropped below its 50-day moving average for the first time since November. We had a little bit of inflationary news on the economic data that came out on Friday. That was the import prices. That was higher than estimates. So on Friday, we had the money center banks came out with their earnings. They were kind of mixed. The problem was that interest income was going to be lower than estimates. And then we had the bank shares trade down, and we had the financial sector ETF, which is XLF, President Frank, dropped below its 50-day moving average for the first time since November. We also had another inflationary reading on import prices. They rose more than expected. They were up 0.4% versus 0.3%. And then the University of Michigan Consumer Sentiment Index fell to 77.9. They were looking for 79.9. That's one of the lowest readings we've had in quite a while on that. So it's another day where we had rates pop up and equities sank. And when I was talking a little bit about the narrow rally earlier on about the NASDAQ too, when you have something with low volume and you have the advanced decline line is basically about even, that type of thing, that's called and even though the NASDAQ made a new high, it's called an unconfirmed high. In other words, the internal breadth did not confirm that the NASDAQ was breaking out to new highs. And that was one of the things we brought up in the daily comment, that don't take this as a start of a new leg up. That was probably going to be a bad day on Friday. So anyway, going on from there.
Okay, and how did the major averages finish up for the week?
Major averages were basically down for a second straight week. The Dow Jones and the S&P 500. The NASDAQ was down for the fifth time over the last 6 weeks. It was actually trading positive until Friday's sell-off. But, 5 out of 6 weeks shows you the NASDAQ is not doing too well. We also had a pretty big tumble in the Russell 2000. It was down 2.9% last week, so it's down about 3.5%, I think, over the last month or so. And the reason for that, you had a lot of people talking about rates come down. The small caps would be one of the big beneficiaries of that. Well, okay, the opposite is happening. As rates go up, the small cap index is actually getting hit the hardest, and that's something that you need to be aware of.
Okay, and how is the technical condition of the market doing?
The technical condition of the market did deteriorate last week. In most cases, we saw the major averages trade down to key moving average support levels. Dow, I think, the Dow traded down to its 100-day moving average. It did break below that yesterday. And then we had S&P 500 and Philadelphia Semi-Index trade down to their respective 50-day moving average, and I believe they broke below that yesterday. The Dow Jones Transportation Index broke below its 200-day moving average on Friday. That's the most support levels that we've tested since November on these major averages. So that's something to be aware of. Yes, and yesterday most of them kind of tumbled below those support levels, and we'll come up with some new targets on those. We saw the market was a little bit oversold on Friday. The SRO got down to 5%. Around there, I think yesterday on the yesterday sell-off, we got down around 6.5 or something like that on the SRO. So we are getting to a level where I think the market could get a little bit of a bounce. The VIX traded up to 19 something on Friday. It turned around and it settled at 1731. And in the weekly letter, I put for the downside targets for the Dow was 37.6. We came within 100 points of that, which will be followed by 37,000. And then for the S&P 500, downside target was 50.70 to 50.80. And yesterday we closed at 50.60. So we did basically hit the S&P 500. I will have a new target for that possibly tomorrow or at least by Friday, the target on the downside, because I do think we have a little bit further to go, although we could see a little bit of a bounce here in the next day or two.
And how is the underlying market breadth doing?
Underlying breadth, like I mentioned, what was weak for the NYSE and the NASDAQ, both advanced decline lines lost ground. I mentioned that NYSE line, that's kind of looked at as one of the few leading indicators for market direction. And usually you'll see that top out anywhere from a couple weeks to maybe a month or so before the actual market tops out. In this case, the last time we had a new high in the NYCAD line was about 2 weeks ago. So that's something that's showing negative divergence, which is a sign that if you're following that on the market recap charts that we have on the homepage, when you start to see that, that should be a red flag for you, and something that you should have in your memory bank there that says, oh, hey, okay, this thing's not confirming that we're making new highs here. Maybe you just want to be a little bit more cautious. So that would be something that I would recommend that you kind of keep an eye on.
And how are we looking for investor sentiment?
And then investor sentiment still remains a little bit overly bullish, but we are getting a little bit more of a pullback kind of to reversion. The week before, the percentage of bullish investment advisors had hit a 3-year high up to 62.5%, and we saw that drop back down to 58.1, which is still bearish. However, what's more concerning at this stage is that the bulls outranked the bears at a 4-to-1 ratio, and that's last time we saw that, I think, was in, I want to say 22 or 21. It's been quite a while since we've seen the bulls outnumber the bears like that. And then we did see the hedge fund managers' exposure index slip back down to about 81%. They were on margin 2 weeks ago. They were up around 104% exposed to equities. They've been kind of lightening up on that for the last 2 weeks. So that's something to kind of be aware of. Now, what's the main thing I wanted to get across last week on Friday was that with this third month in a row of inflation coming a little bit higher and inflation rate, moving up into the 5% range, especially on the 2-year, the 10 years up here around 4.65, 4.7, somewhere in that range. The dynamic of this whole market has changed. Okay, as of yesterday, I think the Dow has surrendered almost all of its gains for the year. I think it's up like 60 points. The Russell 2000 is actually down several percentage points for the year, and that the fact that rates are moving up again rather than down, and the fact that a lot of this rally was triggered off of the Fed saying we're going to cut rates at least 3 times this year. Okay, well now that has stopped, and they're not saying that now. The dynamic that's just triggering this market up to new highs is gone. Okay, the small caps are not going to outperform in here. It's something that you need to kind of be aware of. It's inflation is remaining stickier than what they anticipated. That is going to change. And another thing we've seen as inflation goes up, and the rates go up. I mean, you're going to see businesses, borrow less money. And in fact, at the beginning of the year, FactSet Research had estimates for the first quarter blended earnings for the S&P 500 to be somewhere up around 5.7%. As of last Thursday or Friday, they've taken that all the way down to 3.2%. But year over year, we're looking at about less than 1% for earnings growth in this first quarter. So that's something to be aware of. But again, with rates staying higher for longer, and some of the different Fed officials, like on Friday, I think Mary Daly came out from the San Francisco Fed president. She said that, there's too much talk about how many rate cuts we're going to have rather than what we're trying to accomplish. We're on track to bring inflation down to 2%, and we will maintain policy as long as necessary to accomplish that. Okay, so that now we're going to start to get the debate of whether or not we will have a soft landing or a no landing, which was kind of taking over the rhetoric here lately. It's probably now we're going to start to talk about, okay, how weak is the economy going to get? And we'll start to see that in jobs again. The jobs reports will become more important as rates stay up like this. Now, my opinion on rates is the Fed's kind of a little bit in a pickle in the fact that they cannot, if we do start to slow down, they can't come in here in September, right before, a month before the election or so, and all of a sudden say, okay, we're going to cut rates. That's going to, jack the stock market up. The reason they can't, I don't think they can do that for the first one, is because then it will be looked at as manipulating the election in the fall, and they can't have that. But I do think that they do want to cut before the election, just to kind of, they want things to look good for the incumbent president. So I think that we're probably going to start to see a little bit of a chance of a July rate cut. And then, possibly, and that way they're kind of, it's, 3 months or so, almost 4 months before the election. And that way they can't be accused of manipulating things. So I would still hold out that possibly we could get a quarter point rate cut in July. According to CME Fed Group, that's kind of a coin toss right now. But my inclination is that they probably will try to get a little something in there to boost the sitting president. He's their boss. So that's my thoughts on that. Again, if we see the economy begin to slow even more, then maybe they can get away with using that as, to prevent a recession. We're going to cut rates more than once, but we'll have to see on that. So anyway, so going into this week right now, again, we have more earnings coming out. Goldman Sachs came out yesterday. They had a killer report. Today we got blowout earnings from United Health Group, which has had some problems lately. It was up about 7%, which led to about a 200-point bounce in the Dow Jones to start the day. It's still up. I told you I thought we probably could get a little bit of a bounce today. Then we had Bank of America, Johnson & Johnson, and Morgan Stanley. They pretty much all delivered better than expected earnings. However, they're trading a little bit different results on the trades from their earnings. We also had industrial production was up 0.4% for a second straight month, which is solid. On the downside, we saw housing starts fall 14.7%. That was way below estimates. Again, part of that is the fact that nobody wants to sell their house, and they're having problems with the 30-year mortgage getting up here around 7.5%. People are just waiting to see what's going to happen, especially if as long as people keep talking about rate cuts, you're probably going to have less people wanting to go out and buy houses. So the rest of the week, I think you just want to keep on earnings. We'll see how they go. I do think we probably are going to see more signs of more weakness. It's going to be still a lot of volatility in the market. There's nothing out there at this point that's that I can see over the next couple of days that could make this thing bounce. I think you'll see individual stocks come out, and because this earnings thing where facts that we're looking at maybe 3% earnings growth. The big cap tech stocks are looking at 20%, 25% plus earnings growth. So you could see some big moves. And being overweighted, especially the NASDAQ, you could see some big intraday bounces in some of these stocks. And if it's the big cap Magnificent Seven, that could keep the market, could produce some pretty good sized bounces. I wouldn't be shorting, despite the fact that I see the market going down. I certainly wouldn't be shorting a lot of this. I'm not looking for that much of a downside. In other words, because I think that some of if the big cap tech stocks do report better than what I'm looking for, it could kind of keep a floor underneath the market in here. So look for volatility to go along here. Look for the individual stocks because to be moving things up and down. And then also, listen, we have several Fed officials talking during the week. We want to see if they're all on the same page or whether we're getting some distance between the different members as to what they expect to see going forward with the rate cuts.
Another thing that really stood out to me this week was the S&P Oscillator by MarketEdge closing the week at negative 5.05%. And we are still trending downwards this week, as you mentioned. Can you elaborate on the importance of this and how traders can interpret it?
Okay, the SRO, the MarketEdge S&P Short Range Oscillator, you hear Jim Cramer talking about that on his show. That's his favorite oscillator in the market. Yesterday we closed at 629. That is probably the most oversold the market has been. I can't. I'm not sure when. I think it was sometime last summer when we sold off. It might have been August or September maybe. But anyway, when the thing gets down over like 4.5 or so, it's considered oversold. When it gets close to 7, generally you'll see the institutional investors and hedge funds start to buy up. They think that's we've had too much of a sell-off. And in fact, I think the Dow's been down something like 9 out of 10 days. So, of course, we're oversold. Now, one thing about that, sometimes you'll see some big swings up and down in the market, and you'll see the oscillator, it doesn't move much. And one of the reasons for that is because from January or December up through the 1st of April or so here, when the market was climbing every day, there weren't very many times that we were overbought, and the reason being, the S&P oscillator looks at everything. It's looking at the small caps. It's looking at the Dow. It's looking at the NASDAQ. It's looking at the AD lines for the NASDAQ, for the NYSE. It's looking, where we are above different moving averages. And it's looking at the big picture and not just, if you look at like the 14-day RSI or 9-day RSI on, say, the NASDAQ 100 or the NASDAQ or even the S&P 500, there are going to be times when you'll see that one indicator jump up to 76, 75. And on the weekly charts, it was back in March, it was 75, 76, several indicators, meaning that, hey, this is very overbought. However, when you look at all of the market, with the AD lines and other features, besides just the momentum indicator there, it was saying that, okay, this isn't all one-sided trade. You do have, you do have things going down. You do have things going sideways. You have some stuff going up, in the NASDAQ and stuff because of the overweighting of the Magnificent Seven, which causing that one index to be overbought. But the broader market is not overbought. Okay, now with this S&P oscillator down here at 629 today, I would imagine we probably will go down a little bit more. That's because of the weakness in the transports, the weakness in the Russell 2000. You have the Dow going up today; it was up 200 points at one point. That's not going to, just that one index going up, and the fact that it's just one or two stocks in that index is not going to say, oh, okay, we're no longer oversold. It kind of takes that into view, and then takes the rest of the market indicators and that we look at, the underlying breadth, that kind of stuff, and the how far away we are from different moving averages, that type of thing, and it measures all that, and that's why we'll probably see a continuance of the downside in the oscillator. But when we get around 7, you'll hear Jim Cramer talk about that, and he'll say, we're probably due for a bounce at this stage. If we break 7 on this thing today, you'll probably hear him mention that tonight. So if he does talk about it, and you want to know more about that indicator, we are the only place where you can buy it. You go onto our homepage and look at the S&P oscillator there, and you can actually buy the thing right there. And, it's used by all the institutions. We give you a great deal on it at a discount. You get access to other tools when you subscribe to that also. So that's about it on that. As far as I mentioned before, I think that it'll be another volatile week. I think the pressure is going to remain to the downside, but we are getting oversold to the point where you could see some, especially in individual stocks, where you could see some bounces in this thing. And of course, it goes without saying, geopolitical risks in this market, especially if we would see Israel come back and bomb some facilities in Iran or something like that, you could see oil prices go, shoot back up towards $100 a barrel. If that happens, of course, you'll see more of a sell-off. Of course, that's inflationary, and that's another risk that we're sitting on in here. But you don't want to try to invest like that. You want to look at the bigger picture and stuff like that. But just kind of have in the back of your mind that you do want to be a little bit cautious in here with all that's going on. And if earnings start to disappoint on a bigger scale, then we could see more of a sell-off. And I will try to have some downside targets for you before Friday. Like I say, the ones I put out this past Friday, we basically already hit. And so if I can get something out maybe Wednesday or Thursday before that, I'll try to have them up on the daily.
Okay, well, that definitely puts things into perspective, and we'll definitely keep an eye on that S&P oscillator value going forward. David, we are actually running out of this time, so I do need to wrap up this week's Tech Talk Tuesday. We want to thank you to all of our listeners for tuning in each week. Be sure to like and subscribe so that you can not miss any of our future episodes. Thank you again for listening, and we will catch you guys next week.